Did you know that 78% of the U.S. workforce is currently living paycheck to paycheck? The majority of this country is only one accident or one mishap away from dealing with real financial trauma. A good starting point to get out of this paycheck to paycheck issue is try to build yourself a $1,000 emergency fund. It's very important to build yourself a safety net. What you want is, at least if you have nothing saved at the moment, try to get $1,000 put into an account that's just for emergencies. So if you ever get in a car accident, or there's a medical payment, or something breaks down, $1,000 is usually enough to fix that situation. $1,000, that's a lot of money for an emergency fund, especially if you're living paycheck to paycheck. But think about when that emergency happens, not if it happens, and it will happen, how much better you'll feel knowing that you can lean back on that without borrowing money. How do you build that $1,000 emergency fund? Well, what I would first challenge you to do is there anything that you don't necessarily need that you're spending your money on? Do you have any memberships that you just forgot to cancel? Do you have a gym membership that you just don't bother to go, but you're still paying $10 to $30 a month that's just being wasted? Are you overdrafting your bank and you're having overdraft fees? Can you get a better handle on that? Are you a smoker or a drinker? Do you like to go out to eat a ton of the time? Maybe you could pack your lunch. Now, some people, when they have an emergency, and if they don't have an emergency fund, they may be inclined to go to a payday loan. And I want to show you how bad these loans actually are. So let's say you have a $300 deductible, something came up, you need $300 immediately, you get a payday loan or something of that sort. Their fee is about $45. Here's their fee schedule in general. It's about $15 per $100 borrowed. Your term is about 14 days, and what they don't tell you is what your annual percentage rate actually is. Your APR comes out to about 391%. That's ridiculous. People might be afraid to use a credit card in that instance, but let's just say you're able to pay $50 off a month, and let's just say you borrow that money for a 1 month period. Even if your interest rate was 23%, you're only paying about $6 on that $300 in terms of interest. That's much better than what you would pay for a payday loan. Even if you had a penalty APR of close to 30%, it'd still only be $7.50 for a 1 month loan rather than a 14-day loan. There's something also, it's called peer-to-peer lending, and if you go into here, you can usually get somewhere about 6-10%, about that range, and you can get, sometimes it's a minimum of about $1,000, but it's a much lower percentage rate, and if you're going to borrow for a much longer period of time, you could do that as well, and it's much lower interest. There's a few other sites, and I can show you them now. Here's Upstart, Funding Circle, Prosper Marketplace, Circleback Lending, Peerform, and Lending Club. There's a few others, but just a quick search, I was able to find those. So what they were able to do is, if it might not be as low as $300, you might be able to borrow, say, $1,000 to several thousands of dollars, but you'll have a much lower annual percentage rate, and you can increase the term. So sometimes this is pretty good for remodeling a house, or if you have medical payments or something happened with your car. I want to caution everyone. There is good debt and there is bad debt. Good debt is something that you're borrowing money to either invest in yourself, like going to school or picking up new skills, which will enable you to earn more money, or maybe it's equipment for a business or something like that that would also help to generate income. That is good debt. Bad debt would be, hey, I like these sneakers, or I want this TV, or I want something. Those things are bad debt. They're not generating more income, and they're not helping you to move ahead in your life in terms of becoming financially stable and secure. So the thing that makes payday loans especially heinous is that most people are unable to pay back the entire loan amount within one pay period. So they might be able to cover the fee, and let's just say they cover $50 off the principal. So instead of $300 for the loan. Now they take a next payday loan of $250. They'll be charged an additional $37.50 for that loan. And the next payday, they go down to $200, and so forth and so on, until they eventually pay it off. When they eventually pay off that payday loan that they've rolled over so many times, they've paid over $157 in fees. So that initial $300 charge that was covered by a payday loan has now cost $157.50 in fees, which brings the total amount that was paid for that initial $300 loan, principal plus interest, is now $457.50. If that person took the same charge on a credit card, even at 23% interest for the 3-month period, they would have paid $17 of interest, which brings it to $317.25. Even if they have penalty APR, the interest rate on your credit card, in most states it's maxed out at less than 30%. They would still have only paid $22.49 for that 3-month effective loan, which means the total cost would have only been $322.49. If this person was able to take out a peer-to-peer loan for $300 over a 3-month term at 10% interest, they still would only have paid $7.50. So they would only have paid a total of $307.50 for what that initial charge was. When you compare that back to the total fees that people are paying for these payday loans, the poor are getting poorer and poorer, and basically it just goes into this endless cycle. What peer-to-peer lending allows you to do is, say you have money that you want to let other people borrow, but you don't want to lend it to just one person. What these peer-to-peer lenders will do is, say you have $1,000 saved up, you give it to the peer-to-peer lender, and they divvy it out and diversify what those loans would be. So instead of loaning to just one individual, you'll loan that money to, say, 100 different people on 100 different loans. Now, some will default and not pay the bill, but the vast majority will pay the bill, and that would then enable you to make interest on your money. And you can look at, are they, what's their credit score? If it's below a certain amount, you don't lend to them. The lower the credit score, the higher the interest rate, but the higher the risk that they may not pay back the loan. Remember, all investments carry some amount of risk, and you have the potential to lose some or all of your money when you invest. It's not FDIC or anything like that option, and this has only been in the last few years that you actually have access to consumer credit to actually lend. So you effectively become the bank for other people. I've also heard that people should have about 6 months of income saved in case of a job loss or something very traumatic, because sometimes it takes up to about 6 months in periods of recessions and things like that to get back on your feet. Well, I hope you learned something today. If you have any ideas for a future video or want to leave any comments, put them in the comments. Thank you for listening, and good luck on financial independence.